Hello everybody, and welcome to this video that we are very excited to show to you. Today we are doing it slightly different than usual. We are not going to benchmark different stocks. What we are going to do is to run over some different investment types that you can select from as an investor. We're going to compare and benchmark them, tell them what are the differences, what are the pros and cons of each one of them, and we're going to try to tell, depending on which kind of investor you are, which of these investment types will suit you the best. So to kick off, we are just going to run over the different investment types, and we have selected 4 for you. So the first investment type that we're going to run over is mutual funds, where a group of investors pool together their resources and let them actively be managed by a fund and a fund manager who invest in stocks, bonds, or other assets. So for investors, that means that you do not have the control. The fund obviously have a prospectus that determines which kind of area or sector that the fund is intended to invest in. However, in the end of the day, for a lot of mutual funds, the fund manager has quite some liberty to decide over which way the fund should go. And that means for you as an investor, you obviously get simplicity and diversification very easily, because you are not sitting managing all the trades, all the different purchases of the individual securities. However, on the other hand, you don't have the control and neither as much transparency over what the fund manager decides to do. The next investment type is what is called index mutual funds. This is a more form of passive investment. It is still managed by a fund manager like with mutual funds. However, this time he needs to track an index, sector, bond, etc. So you, as a group of investor or an investor, you put money into a fund that is still managed by a fund manager. However, he's much more restricted in what he can do under an index mutual funds, because his sole purpose is to mimic or follow an index, a sector, or a bond. So again, he doesn't have the freedom to decide what he wants to do. He needs to follow the purpose of the fund solely. And what does that give you as an investor? It gives you a lot more transparency in what you are actually going to invest in. The third investment type is what is called exchange traded funds, or more commonly known as ETFs. They have gained massive popularity in recent years, and is also a form of passive investment where a fund manager tracks an index, sector, bonds, etc. So it shares some of the same characteristics as the index mutual funds from this perspective. However, there's differences between the two of them that we will touch upon later in the video. But basically, an investor or investors go to the stock exchange and they buy an ETF share. However, the ETF is still managed by the fund manager, who is actually doing all the trading of the securities in the ETF. In general, as mentioned, they are trying to mimic an index. However, it is very important to note that there also exist active ETFs or active managed ETFs, which share some of the same characteristics as the mutual funds, and we are also going to touch upon them later in the video. However, most ETFs are passively managed and has the same characteristics as index mutual funds. So the last and fourth investment type that we're going to run over in this video is probably the one that is most commonly known to most people. That is where you go in and buy individual stocks on the stock exchange. So you as an investor, you are the one taking the decision as to which stock to invest in. You can select Facebook, Apple, Exxon, General Electric, whoever you may. You buy and you sell accordingly. You are the one in control. You are the one taking the decisions. So now that you have an understanding of the different investment types, we're going to dig a bit further into the characteristics of each, and we're going to compare the differences and similarities across. So first is access to diversification. When you buy a piece in a mutual fund, you are going to get diversification immediately, because the fund is trading a lot of different assets within their prospectus. On the index mutual fund, you're getting all the assets within the index that it's following. Similar story with ETFs. With stocks, you're just buying an individual stock, so that's a very limited exposure that you're going to get. The next is traded on exchange. Mutual funds and index mutual funds are not traded on the exchange. You cannot buy them. You will have to buy them through the mutual fund or through a reliable website or your broker, bank, whatever. While as ETF and stocks are all present on the stock exchange and you can buy a piece in them. This also means that intraday trade pricing, mutual funds and index mutual funds cannot be traded while the market is open. You can only do it once a day, once the market is closed. So that gives you some restrictions, while as for ETFs and stocks, you can trade them throughout the day once the stock market is open, so you have a lot more flexibility. And in that regard, these 2 points are the main difference between mutual funds and ETFs and stocks. Next part is management fees, which are the costs that you're going to incur to have somebody to sit and manage the trade on your behalf. We're going to touch more upon this later in the video. However, what you need to be wary about is that mutual funds in general have high cost, while as index mutual funds and ETFs has lower cost. For stocks, you obviously don't have anybody to sit and manage it, so it's going to be zero. Commissions in general are low for ETF. Sometimes there's no commission fees at all. However, it is mostly common that there is. For stocks, it is low if you're only buying one stock. However, if you want diversification and buy a lot of different stocks, obviously these costs are going to creep up and can become quite expensive in the long run. Index tracking wise, we've already touched upon this. That is index mutual funds and ETFs. They are also in general passive investment types, while as mutual funds and stocks are what we consider more active investment styles. Now we're going to dig into the mutual funds, the cost, whether they are considered cheap or expensive, and also how the cost structure is built up. So in general, mutual funds is more expensive than the likes of ETFs and index mutual funds, although the costs have come down. So if you see here in the graph, we have actively managed investment type in the blue line, which is where mutual funds fall under. We also have the black line down here, which is passively managed, and this is where ETFs and index mutual funds fall under. So if we take a look at the actively managed first, we can see that since 2000, it has come down from 1.06% all the way down to 0.76%. So quite of a decrease. However, if we note on the passive managed tier, they have also come down from 2000 from around 0.27% all the way down to 0.08%. So there is quite a big of a gap here between the two. And for this to be worthwhile, it obviously needs to be compensated somehow through the return of the investment. Next, we can take a look at the typical mutual fund fees. One of them is that you have the expense ratio, which is charged every year, and it's usually a percentage of the asset under management, also called AUM. Then they can also have, as we just touched upon before, some advisor fees, which is the cost that is charged for hiring a financial advisor to manage the trade. And again, this can often be charged as a percentage of the AUM. And then in the end, you have some mutual funds that charge investors what they call a front end or back end load. And that's basically either when you buy into the mutual fund, you pay a fee, or when you sell, they take a fee. And this typical fee can often be around 5.75% of the amount invested, so quite significantly. So to try to illustrate how big of an impact these expenses can have on your return, we thought it would be good to look at some simple examples. So first, we could see a situation where you consider to invest 100,000 over the course of 30 years, and you will get a return of 6% annually. You have the option between mutual funds or ETF with the below cost, 1.5% for the mutual fund and 0.35% for the ETF. So you can see here on the graph, over a 30-year period, the ETF will have generated you around 522,000, while as the mutual fund will only have given you around $355,000. And the only difference, because both of them are generating the same returns, is related to the difference in the expense ratios, which for the mutual funds is just going to eat up the profit throughout the years. So this is something that you want to be very cautious and understand before you invest in either one of them. Next, we can also look at another example. Again, consider that we invested 100,000 in a mutual fund, charging 1.5% in fees annually, and assume over the next 30 years the market turns in a flat performance, do not generate any return, you will see, not considering inflation or anything, that your investment goes from $100,000 all the way down to around $64,000. So again, a huge difference. The mutual fund cost can really have a big impact. So we cannot control the market. You cannot control the decisions taken by corporate management or by the politicians, but you can make sure that you reduce your investment fees to a minimum, and you should do so because it will pay over time to do so. But again, you are leaving the decision in the hands of a professional who have all the time in the world to analyze the stocks, so he must be good at it and he must be able to generate a very good return. Sadly to say, this is often not the case. A study shows that from 2000 to 2006, S&P 500 was only beaten by more than 50% of mutual funds in 4 of the years. So if we take a look here, in 2000, there was more than 50% that beat the S&P 500, small percentages above here in 2005, a little bit more in 2007, and around 50% again in 2019. In all other years, mutual funds on average were performing more poor than the general index. And over the last 40 years, S&P has outperformed 98% of mutual funds. And a Yale study showed that there's 1 in 49,000 chance to pick a fund that beats the S&P 500 over 30 years. So you're here in a situation where the expense ratios in general are higher for mutual funds, and it illustrates that most of them don't even perform better than the general market. Again, this can be illustrated here by looking at the performance from 2003 up to 2019 for different large, mid-cap, small-cap and multi-cap funds. Here, on opposite, you want that to be below 50 because it is showing how many that is underperforming the benchmark. But as you can see here, most of them are above 50 in all cases. So it's a clear illustration that research demonstrates that mutual funds in average does not perform better than the general market. Okay? So you need to be really careful picking a mutual fund, as statistically many do not beat the market and even less do over the long term. So we've now seen that mutual funds in general are an expensive investment type, and they in general do not perform better than the general market over the long term. So does this mean that you should never consider buying a mutual fund? In our opinion, it does not mean that. However, what you need to be 100% sure is that you value the opportunity active management give to outperform the market. You may have found a mutual fund that consistently beats the market and which is not offset by huge fees. You want to invest in smaller sectors with less trading volume and coverage, where the mutual funds can take advantage through detailed research and strategy. So basically their analysis is valuable. They are maybe finding a gap in the market for these kind of stocks that do not have the same exposure as some of the large caps one, which is being covered on a more general basis. And last but not least, mutual funds actually tends to perform better in volatile times. And at the moment, we are in very volatile times. The last 2 weeks has been quite tough on the stock market. And if we take a look at the graph that we looked upon a little bit before, we can see that around the dot-com bubble in 2000, on average, mutual funds were actually doing better. The same when the financial crisis hit in 2007, again, the mutual funds overperformed the general index. And I think these two observations are quite interesting when we're looking at the unique situation we experienced this year in the stock market with the coronavirus. And it may therefore be worthwhile to look at how the mutual funds have been performing since March when things starts to crash down the first time, and which they may do again now in the coming weeks or months. So in general, we are not in favor of mutual funds simply because the return often does not outweigh the cost. But it does not mean you should never consider it. You should definitely take a good look at mutual funds, because you may find this diamond that is consistently doing well. And again, it may be that even if it has high fees, the return still compensates compared to investing in another investment type. So again, consider it, but research tells us that it is not the best investment option. So now we move into the index mutual funds, and where that differentiates from the mutual funds is that it seeks to track and index a sector or bond, while as a mutual fund has a lot more flexibility. The fund manager can more cherry pick what it feels is a good investment. We also saw that the index mutual funds in general are cheaper than investing in mutual funds, but we also want to understand how it stacks up against an ETF, which is in many ways a similar investment type. So we found this graph that shows the expense ratio development over the last 15 years. And as we can see here on the green line, that the ETF has gone down from 0.27% all the way down to 0.17%. However, it is not enough compared to the index mutual fund, which went down from 0.21% all the way down to 0.7%. So again, not a huge difference between the two, but a difference that may make a difference in the end. And what determines which of the two is the most expensive or cheapest is depending on two factors. One of them is the cost of trading. For ETFs, that is the commission fees every time you buy and sell. From index mutual funds is the front end or back end load fee that you incur either when you buy or you sell with the fund. Last but not least, there can be difference in the annual expense ratios, which is a typical percentage of the asset under management. So index mutual funds is in general cheaper than mutual funds. You can also have cases where they're cheaper than ETF, but it definitely does not always have to be the case, and there's no conclusive research on this. So this is something you really want to investigate when you benchmark an ETF versus an index mutual fund. We then want to understand how the performance of index mutual funds have been. And as we saw earlier, mutual funds have in general not been able to outperform the general market or passive investment type, which index mutual funds fall under. And we thought it was quite interesting to see this graph, which shows the rise of US index funds. And it's basically a measurement of how many trillions is invested in actively managed investment type and passively managed investment type. And what we can see since around 2007 is that although actively managed have increased from 3 to around 4 trillion, it is the US index funds that have done the biggest increase and has gone from less than 1 trillion all the way up to the same amount, around $4 trillion in 2019, and it seems that this will surpass the actively managed investment type during 2020. So again, this also tells a little bit about why so much money has been moved into the index mutual funds, simply because they in general have been performing better. The performance of index mutual funds will in general be similar to that of an ETF, as they are tracking the same underlying index. However, we found a small study from 2014 that concluded that ETFs had outperformed the likes of the index mutual funds. But I think it's similar to the cost for these two investment types. There's no conclusive research on whether index mutual funds outperforms ETF or vice versa. But in general, they should not be too far off from each other because they are following the same type of principle. So in the end of the day, which one should you go with? Should it be the index mutual funds or an ETF? Well, in the end of the day, it's a matter of personal preference. As we saw, one of the big differences is that ETFs can be traded on the exchange and can be traded throughout the day while the market is open. So the ETF gives more potential for more control and active trading, but this also comes at a cost of commission fees, which the index mutual funds do not have on a general note. It's very important who has the lowest overall expense ratio, because over time this matters. And last but not least, the price of a mutual fund is not similar to that of a stock price on ETF, because it's the net asset value of the underlying security, which is only set in the end of the day after the market has closed. An ETF price is like any stock price. It can continue to change throughout the day, and you know when you buy which price you're going to pay for it. So these are the major difference. And if you as an investor You need to see which one you value the most. For us, we in general prefer the ETF over index mutual funds for the flexibility of trading. However, we do recognize that both of them can complement each other, as index mutual funds may be performing better or be cheaper for a particular index. So again, I think the recommendation is for an active investor, you will want to go with the ETF, while a more passive investor who do not need to do a lot but just wanted to stay and develop over time, you may prefer the index mutual fund. So we have now had a look at mutual funds, index mutual funds and ETFs, but what about stocks? We thought it would be good just to do a short recap of the difference between ETF, index mutual funds and stocks. First of all, the investment type, it is pooled securities, and for stocks it's individual security. That means that the market exposure for ETFs are more broad, while as for stocks it is more focused. This is the whole diversification we talked about initially in the video. The risk versus return in general, lower risk, lower returns for ETF and index mutual funds, while as for stock it is higher risk but also higher returns. In terms of control, obviously the fund manager in the end of the day has the control, although you quite often know what the fund manager is going to do because he is following a specific index or a sector. However, you have more investment control when you are taking the decision yourself. You can on stocks exactly decide what you want to invest in. The research time in general is less for ETF and index mutual fund because you're taking a more holistic approach on the industry or a sector or an index, while as for stocks you need to be more research about the individual stocks and you need to be more specific. So in general you tend to spend a lot more time on the stock side than what you would do on the ETF side. And then last but not least, on the fees in general, it's low for the ETF and index mutual funds because you get many companies in one share, and for stocks it is low if you only buy one, but if you want diversification it is going to be high. So in general, does individual stocks give better returns than the likes of ETF and index mutual funds? Well, it depends on you, because let's imagine we took a look at this 5-year return for selected S&P 500 stocks and we benchmark that against an ETF that tracks the S&P 500. So imagine you had been putting all your money in some of the FANG stocks that we are showing here. You would have gone over a 5-year period with Alphabet from index 100 to 216, so more than 100% increase. It would have been fantastic. Even better would Facebook have been with 267, and Netflix with amazingly 474, really good numbers. However, you could also have put them in GE, Gap or Kohl's Corporation. You would have lost money. You would have gone to index 78, or you would have lost 50% on Kohl's, or you would have lost 74% on GE, so a massive loss. ETF or index mutual funds is in general the safe middle ground because it encompasses all the various stocks within the S&P 500. It takes some of the bad apples for sure, but it also takes the really good ones. So if we look here over a 5-year period, you would have gone from index 100 all the way up to 164. In the end of the day, it may be fantastic to get the big boys over here, but it may also be very good to avoid these guys down here. And the ETF gives you that safety, we would say. And again, what is the possibility that you can consistently beat the market? You may be able to pick out 1 year a few good stocks and it goes really well, but maybe the next 3 or 4 years you will hit the bad ones. As we saw earlier in the video, the mutual funds who are more following this kind of strategy, they have not performed better than the market. So the chances are that you as an amateur investor will be able to do better. It's not impossible, but it is definitely challenging. So as we have stated a few times in this video, in general ETFs are passive investment that tracks an index sector, bonds, whatever, currencies, real estate, doesn't matter. But actually one of the things that have been growing in the recent years is active managed ETFs. And an actively managed ETF has a fund manager taking the decisions as they see fit on the underlying portfolio allocation, thereby not adhering to a passive investment strategy. So if we look here, it's a bit different because the fund manager no longer needs to mimic an index. And this means that this ETF that is actively managed becomes a lot more like a mutual fund in the way it behaves. Again, research tells us that the performance and the cost of mutual funds is not that good. So this is also something you really need to be wary about with active managed ETFs. However, some of them has been performing really well over the most recent years. One of the ones that is mentioned quite often is the ARK Innovation ETF that looks at investing in securities that have disruptive innovation. And as we look here, the annual return over the last year, 2, 3, 4, 5, 6 years, in general are really good. And it's better than the S&P 500. And although the cost is also higher of ARK Innovation ETF, it is not as much as what you would see on a general mutual fund. I think it's around 0.75% that they charge. And they have so far been able to give an outstanding return. But what is important is to say that it doesn't always beat the market. As you can see here, 5 years ago and 6 years ago, they did not beat, for example, the S&P 500. But it's just to illustrate that there has come more and more active managed ETFs, and some of them looks really interesting. So some of the benefits is that it is similar to mutual funds, but it has the flexibility of trading of the ETF model. And as we mentioned earlier in the video, the fund manager can react in volatile periods. It can take some of the bad apples out and try to replace them with some better ones. The downside is the autonomy of fund managers gives you less transparency on the portfolio and the decision that the fund manager is going to take. And as I mentioned, it has higher expense ratios than traditional index ETFs, although they are not as high as mutual funds. So again, research shows that passive managed beats active managed in the long term. Invest only in proven active managed ETFs that consistently beats the market. So as some final thoughts about what you should consider or what you should maybe do, it is obviously always subjective. Each one of us is different. We have different priorities. We have different goals. And each investment option or type will offer some things that fits to you and maybe some things that doesn't fit to you. And therefore you need to select on that. However, what we can say as a general rule is that mutual fund research shows that they are underperforming. Index mutual funds has historically performed well. It's an individual preference as to go with it or the ETF, or maybe based on the cheapest cost. Similar story for the exchange traded funds, just with the vice versa on the index mutual funds. And then we have with the stocks. Unlikely that you beat the market in the long run. My own experience is also that it becomes a very time consuming exercise, not just to select the right stock, but also to keep track on them afterwards. I found myself in my younger days that I was spending a lot of time consistently tracking the news, reading the news, and actually taking a lot of the free time that I have that I could perhaps have been used on better things than just sitting and reading information about stocks all the time. However, nonetheless, we all really love picking the winner and hit a home run. It is the best feeling to pick a stock that has either been beaten down or is in a growth mode and you just see it explode. So our final recommendation is for most investors, but not all, because it is again subjective. It is to put the majority of the portfolio in an ETF or an index mutual fund. Invest some of your funds into individual stocks for the rush, and only select mutual funds or active managed ETFs if you can find one that consistently outperforms the market. So again, this is the final conclusion of today's video. We hope that you have learned something. We hope that you enjoyed this video. Please subscribe to our channel for future comment. Please give a like if you liked the video. Please provide a comment with your input to this whole aspect. There's a lot of different aspects to it that are really interesting, and we would like to hear your opinion. Please keep in mind that we are not financial advisors, and this is only done for entertainment purposes. Make sure you do your own due diligence before taking an active investment decision. Besides that, we just want to wish you a good day, stay safe. Until then, see you next time.